Hello, everyone. Bonds represent long-term borrowings for a company, a municipality, or the federal government. When a company issues a corporate bond, it is borrowing money from the bond investors for a period of time exceeding 1 year. Typical bonds are issued with maturity terms of 5, 8, 10, 15, 20, and 30 years. The company will use the money for expansion or business operations. The bondholder will receive cash payments during the life of the bond and the face amount once the bond reaches its maturity date. When studying bonds, you need to know how to determine the bond price, cash interest payments, interest expense, and carrying value, and how to retire a bond. What we have here is a model that should help explain bonds to you. In the table labeled Bond Characteristics, I show the bond's face amount, annual stated interest rate, payment periods per year, term to maturity, and the current market rate of interest for similar types of investments. Let's assume the face amount is 100,000, the stated annual interest rate 8%, the payment periods per year are 2. So in other words, this is a semi-annual bond. Remember that bonds typically make payments twice a year or semi-annually. Know also that there are bonds that make quarterly or annual payments. The stated rate on the bond payment per period then would be 4%. If it's 8% annually and it's a semi-annual bond, then the stated rate per period has to be 4% or 8% divided by the two periods. The cash interest payments that are going to bondholders would be $4,000 every 6 months. We get the $4,000 by multiplying the $100,000 face amount by the stated rate per period. That's the purpose of the stated rate, to determine the cash interest payments every 6 months. Since the payments and the payment intervals are the same, the cash interest payments are an annuity. The annual market interest rate is the prevailing annual interest rate for similar types of investments. So investors would look at other investment alternatives and see what types of return they could get. Investors will always want to receive the current effective market interest rate. In this case, the annual market interest rate is 7.6%. To determine the market rate per period, we would divide the 7.6% by 2 and use 3.8%. Since the term to maturity is 5 years, we say that we have a 5-year bond. So the bond is going to be out there for 5 years and then it will mature. Well, if it's out there for 5 years and it's semi-annual, then the payment periods over the life of the bond are 10. We now have the data we need to determine the bond issue price, also called the bond value, at the time that we are issuing the bond. If we use a factor table, we show the number of cash flow periods as 10. The interest rate per period is 3.8%. 3.8% is the effective market interest rate at the time we issue the bond. So when determining the value of a bond at issuance, we always use the market rate of interest. Now the factor tables, as we have studied, have factors for future value of a dollar, the future value of an annuity, the present value of a dollar, and the present value of an annuity. When calculating bond values, we have two cash flows. The annuity amount, which is the cash payment of interest that takes place each period, and the single sum or lump sum, which is the face amount that must be paid at maturity. When calculating the value of a bond, we discount the cash flows to determine their present value. So the only columns we are concerned with are the present value of a dollar and the present value of an annuity. Since the payment of interest is $4,000 every 6 months, we use the present value of an annuity factor and multiply it by $4,000. The $32,769.03 is the present value of the cash interest payments. For the face amount of $100,000, we use the present value of a dollar factor, or 0.68869. We multiply the factor by the face amount to get $68,869.43. Adding the two amounts gives us the present value, or the bond price, or the bond value at the time of issuance, of $101,638.45. Using a financial calculator, we can determine the value of the bond by putting 10 in the N register, 3.8 in the IY register, 4,000 in the PMT register, and 100,000 in the FV register. By pressing the Compute PV key, we get a present value of $101,638.45. In both cases, we got the same bond price, regardless of whether we used factor tables or financial calculators. Now we know that there will be times when there will be a small nominal difference between the factor tables and the financial calculators, because factor tables truncate their amounts while calculators do not. So the first thing you need to be able to do is determine the issue price or bond value at the time of issuance. The bond price is $101,638.45. This is greater than the face amount of $100,000. When that occurs, we refer to the bond as a premium bond. Premium bonds will always take place when the stated rate of interest is more than the effective market rate of interest. If the stated rate is more than the market rate, we are going to get more for our bond. The amount of the premium in this case is $1,638.45. That's the difference between the bond price and the face amount of the bond. For our company, at the time of the issue, we are going to receive $101,638.45. When the bond matures, we will return $100,000 to bondholders. As a result, the true cost of borrowing for our company is 7.6% and not 8%. The $101,638.45 is also the carrying value at the time we issued the bond, and will be the amount that is in the company's general ledger, as well as the amount presented on the balance sheet. Once we've issued the bond, we need to make cash payments semi-annually, record our interest expense, amortize the premium, and determine the carrying value that will be used on our balance sheet. The cash interest payment of $4,000 has been determined by multiplying the face amount by the stated interest rate for the period. To calculate the interest expense after the first payment, we multiply the initial carrying value by the effective market rate of interest at the time of issuance. So we are going to multiply $101,638.45 by 3.8% to get an interest expense of $3,862.26. Because this is a premium bond, we have to amortize the initial premium over the life of the bond. The amount to be amortized is the difference between interest expense and the cash interest payment. That amount is $4,000 minus $3,862.26, or $137.74. The amortization that is taking place is referred to as effective amortization because the effective market rate of interest is used for the calculation. To determine the carrying value for the first payment, we subtract the $137.74 from the initial carrying value of $101,638.45 to get a new carrying value of $101,500.71. Now, to get the interest expense for the second payment, we take the carrying value at the end of the first period of $101,500.71 and multiply it by 3.8% to get $3,857.03. The amount of amortization, again, is the cash interest payment minus the interest expense, or $4,000 minus $3,857.03, for an amortization amount of $142.97. We have amortized another $142.97 of the premium. The new carrying value amount after payment 2 is the carrying value from the prior period of $101,500.71 minus $142.97 amortized, or $101,357.74. This is the amount that we are carrying on our general ledger and the amount presented on the company's balance sheet. The amortization table provides a summary of all cash interest payments, interest expense, and changes in carrying value for the bond over its life. Note that the cash interest payments never change. Also note that both the interest expense and carrying value decrease with each payment. The decrease is taking place because the amortization of the premium is driving the carrying value down towards its face amount. A lower carrying value will always result in a lower interest expense. When the bond matures, the amortization table's carrying value will equal the bond's face amount, in this case $100,000. At that point in time, the company will return the face amount to the bondholder and the liability will be zero. Now, the beauty of using a model allows you to change assumptions and see results. So let's go back to bond characteristics, and instead of having an annual market interest rate of 7.6%, let's make it 8.2%. So remember, at 7.6%, the value was $101,638.45. Changing the 7.6 to 8.2 results in a bond value of $99,192.93. This is an example of a discount bond. Whenever the stated rate is less than the effective market rate, the company will receive less than the face amount for their bonds. So in this case, the discount is the difference between $100,000 and $99,192.93, or $807.07. Look at the calculations for the tables. Look at the calculations for the financial calculator. In this case again, both values are exactly the same. Look at the interest expense calculations, the amortization amounts, and the carrying value amounts. The calculations are the same. The difference when it comes to amortizing a discount is that the discount is added back to the prior period carrying value. The reason why can be seen in the amortization table. Again, the cash interest payments are the same. This time the interest expense goes up with every payment because the carrying value goes up with every payment. Once the bond matures, the bond reaches its face value. And again, the company pays the bondholders the face amount of the bond. One more example. Let's assume that the market interest rate is the same as the stated rate. Whenever the stated rate and the market rate are equal, the bond will sell at its face amount. This bond will either be called a face value bond or a par value bond. Look at the table, look at the calculator. If you do these calculations, you will see that the bond price will equal the face amount. When that occurs, the interest payments are the same as the interest expense amount because there's no premium or discount to be amortized. The carrying value of the bond will always remain at $100,000. At maturity, the bondholders will be paid off and the bond payable will be zero. Hope this video helps. I encourage you to download the model and play with the model. In the model, the only cells that you need to change are the blue cells. So you can change the amount, the stated rate, the payment periods, the effective market rate, and the term. Those are the only cells you need to change. Everything else will calculate for you. To the right of the model, I have a listing of key bond concepts. I encourage you to look at each of these concepts. Make sure that you understand them, because understanding concepts will always make understanding the bond calculations easier. Thanks for taking time to watch this video. And again, I encourage you to download the model and play with the cells. Take care. Good luck.